If the problem of the economy has been too much debt, then I think maybe quality companies getting a premium might be somewhat related to that. So I prefer to stick with other companies that I would say with more volatile earning streams that get perceived as lower quality. Quality businesses, the ones with stable earnings and slightly growing earnings, are ones that are kind of the darlings of the private equity buyout craze.
So when I think of a lot of the original value investors who search for similar stocks to you that are low price to book businesses, not many names come to me outside of, Benjamin Graham or early Warren Buffett. But Scott, you definitely fit this mold. So in your latest manager's letter, you noted that stocks in the Aegis Fund at the end of 2023 were trading at a quarter of the valuation on a price to book basis compared to the S&P 500. So I'm always thrilled to learn more about how investors arrive at their investing strategy. So can you please maybe expand on some of the events, maybe influential people, and just the background in your education that has helped shape your investing philosophy that you've now been implementing for well over 2 decades?
Oh gosh, that's a pretty big question. I got into investing, I think, a little bit later than a lot of folks. I was a mechanical engineer in college. I'd worked at Chevron. I did a couple of the summer jobs at Chevron, and was very interested in being an entrepreneur, and interested a little bit in investing. Had followed some of my family investments, and bought and sold a few stocks, but really didn't kind of catch the bug until I'd gotten out of college, and I took a job at Simmons Company, which is an oil service investment bank, and doing their analyst rotational program. And there I started to listen to the conference calls, with the various oil service companies, and really got really interested in what made the market tick. And I was a very junior guy, but also did the monthly oil service fact sheet. So I was coming up with a lot of the what was going on with the various valuations of the oil companies on a month by month basis. So became interested in why different ones were going up or down as I would track those sheets, and just very got very interested in value investing. There was an individual who came in, a young guy who came in from one of the business schools for their summer, and he'd heard of Warren Buffett, so I'd gotten interested in Buffett and what he was doing, and I just started reading everything under the sun about Buffett and Munger and all these various value investors. And so when I got into business school, I kind of came to the conclusion I really wanted to make a switch. I bought a screen tool, and right when these market screening tools were just coming out, and started looking at if you tighten up the screens really hard, you see what came out, and then went and hunted through the SEC filings and to try to really understand what these companies were about. And I came across my first company was Advanced Marketing Services, which was a bookseller that distributed books through kind of Price, Costco's, and Walmart's, and so forth. And I was trading it was a classic Ben Graham net, and bought it and made some money on it, and that really caught my attention then. And in business school, I saw that Barron's came out, and I think it highlighted the Kahn brothers, which was Irving Kahn was Ben Graham's teaching assistant at Columbia, and worked at Graham Newman, and one of the kind of the value kind of all-star old original gangsters, I guess. So Irving, I'd noticed that Kahn brothers had owned Advanced Marketing Services too, and so I started to reverse engineer kind of what were the other stocks that they looked at, and ended up calling up Alan Kahn, who was gracious enough to start a dialogue with me, and which at that time in my early career in investing was really helpful. And then my big break was in some ways a summer job that I picked up, though. I had a guy named Ken Corngable, who had passed at Wharton, who was walking across the campus, and he told me about a guy who he knew called Donald Smith, who was a deep value institutional investor, and that kind of chance kind of encounter, really changed my life, and because I got to know Don and called him up and ended up working with him and Rich Greenberg over the summer and really starting to really dug into learning the business. And so then for me, after that, I ended up getting to know a number of folks, that a couple of people that had left Kahn Brothers. Alan had referred me to Bill Burno and Paul Gamble, who were down here in D.C. They were the Washington, D.C. office of Kahn Brothers, but had left 2 or 3 years earlier and set up on their own a investment advisor, duly registered investment advisor, broker dealer. And so after my summer, I hung my brokerage license that I'd earned while I was at Simmons with these Burno and Gamble, and I started marketing discounted securities to the street while I was in my second year of business school. And Don was gracious enough to kind of help bring me along and show me kind of the ropes of how to do real good research on these companies, and so started to do that and ended up meeting a whole slew of others in the industry. I remember going to Wall Street, and I wrote Bill Ackman back when he was running Pershing Square, and told him he was maybe 3-4 years older than I was and had started a hedge fund, and so I'd written him saying, hey, this is I'd love to meet you, and I set up a time and I took the train up to New York. One of the first times I'd been up to New York. I hadn't been to New York much, but Bill was kind enough to make a whole bunch of calls and introduced me to a number of other people, and so very, very kind to a really a new person in the industry, which I'm really grateful for. So I met Bob Robotti that day, which was another folks, one of the other folks you'd covered here recently, and got to know a little bit of some of the other guys. But and then when I graduated, essentially I ended up kind of figuring out I could sort of I felt like I had enough interaction with some of these folks and was making enough money in the trading, and that I was kind of might be worthwhile to try to do this on my own. And so I kind of came down and bought into the small broker dealer investment advisor here in town. And interestingly, that on the brokerage side was kind of interesting because they were covering at the time Peter Cundill and Walter and Edwin Schloss. So I got a chance to kind of watch kind of the way they were trading, and how they scaled into positions and the kind of things that they were looking at, and that was a real kind of an eye opener for me around how the business kind of worked, and the kind of things that the value set we're working on and looking at and thinking about. So that kind of that was but Don Donald Smith was really the kind of one of my key mentors in the business over the years, and we've been very close until he passed in 2019. So yeah, that's kind of the genesis of how I got my start. Over the subsequent years, I bought out. I started the Aegis Value Fund in 1998. One of the guys at Simmons, Denny Conselmo, had a older brother, who had started a mutual fund on a shoestring budget, and copying other people's legal work and all the big no-nos. And so I kind of figured out how to do that, and got the mutual fund started in '98, and I'm sort of 27 years into the management of that now. I've bought out my partners in 2006 and 2008. And I've been kind of doing sort of similar deep value investing ever since. So, that's sort of the genesis of my travels.
Perfect. Thank you for that. So one of the most admirable traits that I find in many, many great investors is this unwillingness to sacrifice core principles and philosophies to fit in with their peers. And I think a lot of the people who have influenced you probably have that exact same character trait. So you've been running Aegis, like you just pointed out, since 1998 now. And obviously there's been tons of ups and downs, tons of volatility, but you've essentially maintained your strategy here of, buying low price to book companies all throughout the years. So, with all these bubbles that you've gone through, and obviously you are observing, a lot of these, say like in 1999, high price tech stocks that were doing really, really well. But through all that, you just stuck to your strategy. So I'm just interested in learning a little bit more about, what is it about your underlying investing principles that maybe you've learned from some of these influences that have kind of helped you maintain your path and not get sidetracked by shiny objects?
Well, I read somewhere that when you buy things that are under intrinsic value and you're waiting for the prices to get up to intrinsic value, it's more of an investing kind of orientation. And when you buy things that are above intrinsic value or own things above intrinsic value, hoping for a higher price, that's sort of a wish upon a greater fool kind of an idea. That is more of a speculation or oriented philosophy. I've always had the value philosophy. My history has been sort of an engineer. I'm a mechanical engineer and an economics major. So I was very much, I like the grounding of the sort of the idea of really determining the fundamental value, and owning it at a margin of safety. And so whenever things were higher than that, I really didn't have a lot of guidelines to really determine how to act and how to position myself. And so I was always much more comfortable, just understanding that, here's my assessment of intrinsic value. And if the stock is at a discount and it goes lower, well, then we it's an even better deal. Of course you check your numbers, but if it's still penciled out, then I was not the person to be easily swayed. And when the markets got above intrinsic value or above what I kind of estimate, which I think certainly happened during the TMT bubble in '99, it becomes a very difficult time. And we were almost so small that it wasn't that we didn't really have many clients to lose, but we had a lot of pressure and weren't getting a lot of growth, and we were just sort of sitting there I empathized with guys like Jean-Marie Avillard, who would say, I'd rather lose half my clients than half my clients' assets. So, and so I think there's an element of cyclicality where, a properly positioned investment-oriented firm needs to allow some of their clients to move off, and it's always a struggle to over those periods of time when you're really underperforming a kind of a high flying adrenaline oriented market. But that's kind of the to me, and we just right at the beginning in '99 we'd started out with one of those markets just after we started the fund. And the thing that was so intriguing to me though was that a lot of these deep value names dropped to even lower valuations as the capital flows from investors shifted to chase the shiny objects, as you say, right? And so, it's almost like the real returns that were being offered by the old economy stocks had to adjust to match the, kind of the Ponzi returns that were sort of available in these other, high flyers. So I kind of thought it made a lot more sense to own the old economy stuff that was the jewels that were being sold off, that were really had the baseline cash flows and underlying cash flows that the companies were generating were supportive of valuation. So and that approach seemed to be was fit with our whole strategy and positioned us really nicely for the when things imploded in kind of 01, 02, 03 kind of So that was so that, yeah, that was the start of our kind of the way we dealt with it. Since then, it's been but '08 was a real mess. Just it's just the opposite of the situation. Where everybody's losing assets and so forth too.
So I wanted to go over a presentation that you gave this year for the Ivy Business School that I really, really enjoyed. So you listed some really fascinating reasons for that are responsible for your outperformance. And the one that really stuck out to me was some of the aspects that belong to the subject of being unconventional. So you listed three primary ones here. So one was, do not rely on historical price volatility as an effective measurement tool of investment risk. Consider permanent capital loss the true measure of risk. Number two, we will concentrate capital in a particular sector and on a small number of holdings. And number three, do not manage invested capital to avoid short-run index tracking errors. So I'm just interested in learning a little bit more about, what helped you arrive at these three tenets of unconventionality, and why do you think very few other investors follow these principles?
Yeah, I think there's a lot of confusion, and folks think that the stock price is equivalent to the value of the company, but the stock prices move around in a variety of manners, and the value of the companies will move around as well, but they don't always correlate. And in the long run, it's the value of the company that really is what matters. And so when you have a stock price that, some volatility or huge downward shift in the stock price of some kind, if the underlying company hasn't suffered, the evaluation of the underlying company hasn't suffered or hasn't dropped nearly as much, you can get the investor base very negative on a particular company and thinking that there's more risk involved in the company. When in reality, I think it's once the stock price is dropped, there's it's really margin of safety is much bigger. It's a lot of the air is out of the balloon or whatever metaphor you want to use, and it's a much safer kind of time. So for us, kind of we're much more thinking of what are the true risks that occur in a situation, or risks that really impair long-term value. I kind of put those into three primary buckets in terms of the way I view risk. One is multiple. When multiples are very, very high, even if it's a good company, those multiples can come down just a little bit, and you can lose an immense amount of money. So the higher the multiple, the more really the risky there is, because clearly the growth hurdles that the management teams have to hop over to meet that really high multiple is that these hurdles are much bigger. The second one is leverage. So when companies have high degrees of leverage, clearly the company can get into cash flow problems much more quickly when they stumble or they hit a problematic market or a cyclical downturn. And so companies that employ leverage are clearly ones that have a higher degree of risk to long-term capital. And the third is sort of the fundamental business risk, or your assessment of those fundamentals, business fundamentals, it could be off. And so you think that you got a good company, but you've missed two or three really key fundamental issues that are going on, and those are really three sources of kind of long-term risk that we spend an awful lot of time focused on. And I think the other, when you focus on stock price volatility as a measure of risk, and a lot of quants do this, it can be sort of helpful. But I think in some ways, you're off. You can be off quite a bit. I think folks have gotten very focused on this volatility measure because we've had 10 years of very low interest rates, and there's a lot of leverage in the system. So investors will, they're in pod shops, they're employing leverage, and so they need to have they need to very, very closely watch volatility metrics because they are levered, and they can't they've got to be much more mindful of drawdown, and so I think that gives us a differential view on stocks that might have some near term problems, and we're much more willing to focus in the on the longer run, uh, even if a quarter or two might that directly ahead of us might be somewhat messy. It's kind of our thinking on that. We, with respect to number of concentration on a number of holdings in a sector, or focus on industry concentration or index tracking error. We're guys that focus a lot more on taking really strong positions in companies where we've done the fundamental due diligence. You can't really beat an index if you're trying to replicate it, and so we are really active in the way we pursue our approach.
So there was a quote that you said that I found very, very thought provoking, which was, "I'm often a contrarian, but not always, understanding that sometimes the crowd can be correct." So, seeing as your investments definitely tend to diverge from the herd, I'm interested in just understanding a little bit more about how you have been able to best assess whether, the crowd is right or wrong about a business that maybe you already own in the fund, or maybe something that you're heavily researching.
Yeah, I think when I wrote that, I think I was kind of reminding myself, I'm a kind of a genetic contrarian. When I was a little kid, I one of my favorite books was "Survive the Coming Thermonuclear War." How to do it, which I remember carrying it around on a vacation one year, and I must have depressed everybody. Um, so you know, I think it's really important though for genetic contrarians to realize that sometimes you don't want to just be opposed for the sake of being opposed to people, and that the markets can sometimes be correct in their assessment of things. And often, I think I saw a saying somewhere that the market is the crowd is wrong at the extremes and right in between. Trying to figure out, and as I've gotten older, I've spent a lot more time trying to puzzle through, where we are, and not necessarily, trying to fight my inherent um, uh, dislike of crowds, I guess, to think a little more about, where we might be in that cycle, and that, whether we're at the extreme or, either on the positive valuation or low valuation side.
So, speaking of contrarianism, one of the contrarian plays that I saw that you make was in a business called Orezone Gold, which seems like a kind of a classic contrarian play. So let me just discuss that in a little bit of brevity here. So this is a business that owns a mine in Burkina Faso. The country's had multiple coups d'etats. They've expelled Western military forces from the country, and they have armed conflicts against ideological extremists. So definitely, speaking about what you just said in relation to sentiment, it's the pretty sour sentiment regarding this exact investment. So I'm just interested if you could speak to the thought process on some of these contrarian plays like this one. How are you generating enough conviction in an investment like this when it is clearly surrounded by so much uncertainty?
Yeah, yeah, that's it. Well, Orezone is one of many. We have a basket of these things that make up about a quarter of the fund, and Orezone's one of a dozen or so names. And interestingly, within the resource space, these precious metals mining kind of companies, they can have a whole slew of risks. There could be geologic risk, metallurgical risk, management agency risk, construction, regulatory permitting, country risk. There's a whole slew of them. And Orezone, interestingly, is the geology is excellent. The metallurgy works great. Management is phenomenal. Patrick Downey, he's got a great reputation, having turned around Claude Resources in Canada, and Delradian. It was sold off under his directorship. Um, he was on the board at Delradian as well. So a phenomenal individual. Construction risk, in West Africa, there's the construction generally has been on budget and on time, which is a big rarity in the resource space. Interestingly enough, the regulatory the mine is permitted, and there's minimal permitting problems in Burkina. So what we're left with is country risk, and clearly, on the one hand, like Rothschild said, you want to buy at the sound of the cannons and sell at the sound of the trumpets, and that's the way to really make it in the world. And going back to the contrarian mindset, we got to make sure we're not not maybe the crowd is right here or not, but this is something we're all obviously thinking about as well. There has been a number of coups in the area. A lot of times, though, with the various coups, the mines keep working. There's been a lot of unrest in the country with Islamic fundamentalists coming into the north side of the country, and a lot of trouble. But this is a very, very big country. In the middle of the country is the capital city, and this mine is very close to the capital city. So it's not really right next to an army base. So it's really the idea of this being subject to some of the risks of some of the other mines in the country. I think are a little bit. I think the risks are a little lower. Interestingly, the new military guy, Traore, who took over, was a former mining geologist. So has some understanding of the industry through his own history. And I think they at the core, while they I think they're probably frustrated with the French, who'd kind of run it as part of Francophile Africa. I think they are understanding of the fact that Western know-how and operations are really needed to kind of keep those mines running, to keep the government nicely funded. And so there is a clearly risk in that situation. But I think the returns are, you need to judge risk, of course, but in the context of return. And I think that in the case of Orezone, they're funded to do an expansion of their processing that should increase their production by 80% in the next couple of years. After which, if the current gold price holds on and stays just static, doesn't even go up, but just stays static, I think we're at free cash flow multiples that are almost 30-40%. So once you get the benefit of this mine expansion coming on. So to me, it's one of those where it looks like the reward is pretty darn strong too, and probably offsets some of the risk factors, particularly given that so many of these other risks that plague mining projects seem to be non-existent with Orezone, or minimized, I'd say, with Orezone.
So in an Investor Business Daily interview, you said something that really got my attention. When we're surrounded by many investors and lots of company, we get uncomfortable. So for you, I'm just trying to kind of wrap my head around this situation. Is it simple for you when you're trying to find new ideas? Are you just screening for low price to earnings or low price to book stocks that you think that the investing industry is going to dislike as a whole? Or, is there some sort of other heuristics that you're using in order to help you find businesses that are just unloved and not appreciated on Wall Street?
Yeah, we spend a lot of time in the looking at the watch list, looking at the screens that are coming off of the markets, and the discount to book screen is one of the key ones that we've used to help us sort of orient and focus our kind of limited analytical resources on a subset that we think might provide some of the best returns. And historically, discount to book stocks have done very well against the broader markets. The last 10 years, has been a little more of a hard slog, but clearly, um, I think some of that has to do with the interest rates having been put at sub-market levels and set at sub-market levels, and I think some of that is likely to change. And back in the 70s, where when you last had interest rates spiking and concerns over inflation, the value premium of owning really heavily discounted price to book securities was really, really strong. So we're pretty optimistic that this initial heuristic of evaluating on book is likely to come a little bit more into phase, and deliver some probably pretty solid returns. When we look at the top of the funnel, of course, doing the quantitative analysis of the markets and focusing ourselves at that level is the start. We also look at kind of cash flow, EV to EBITDA, and then we're looking a lot at other indicators of value, share repurchases or buybacks, whether there's a restructuring, whether there's been management change recently or activism. And how much leverage is in the system, or in the stock. If the stock is highly levered, clearly that's one of a big risk factor for us. Bear Stearns at 40-to-1 leverage, even if it's at 50% of book value, the asset value drops a little bit, and the company gets into a lot of trouble. So highly levered entities don't provide that safety, that margin of safety from an asset perspective that very low or unlevered companies typically can. So we watch a lot of those things. We don't exclusively do price to book stocks. Price to book is excellent at picking up companies that are trading that have a real suppressed return on equity because they're at a cyclical low, and so I think that to catch some of these companies at cyclical turning points. Price to book is a very, very nice initial indicator. But we also do EV to EBITDA kind of analyses to more cash flow type metrics in order to pick up some of these companies that are might be producing or producing a little higher return on equities, but the market might be missing something in the and yet they're trading at low valuations on cash flow. So we do some of both, but primarily been book since the get-go, since the origination of the fund.
So one energy holding that stood out to me when I was researching your commentary was natural gas services. So this one has performed incredibly well for you. And I know you noted that during the first time you started buying it, it was trading at a discount about 45% to tangible book value after a large shareholder had exited their position. So, how are you thinking just about the energy industry today? And, are you still finding compelling investments in that sector, even though the S&P 500 is, gone stratospheric?
Yeah. Yeah. Natural gas services was a nice pick for us last year. We've probably made 70-80% on our money, presuming an exit today, which might not have occurred. But a year ago, this was an interesting classic case of a company trading at a big discount to book. There was some perceived CEO turnover, as an old CEO tried to retire, and the new CEO could come in and then had left the business after a short period. There was a lot of big capex that was getting spent without seeing a lot of results in terms of additional margin or additional margin dollars coming in. And so there was a worry that maybe there was a problem there. I would suspect, and then on top of it, there was some significant selling by some other institutions, and that combined to just make it a kind of an unloved kind of entity at the time. But we understood the compressor rental space had followed and owned in the past CSI Compresco. So we kind of understood what was happening. A lot of these, and a lot of these companies, when they in the compressor business, when you spend the capex, interestingly, you don't get the benefit of the compressor being in the fleet earning, for about 15 to 18 months. So there's this long lag from capex to interest earning asset. So when you have a big expenditure and all the debt associated with that starting to come into the book, and you're not seeing the benefit of having that additional enterprise value growth, offset with additional cash flow immediately. There was some concern, but when you study it, you realize that these are long. It's just this long cycle capex that and these what is really going on is that these guys were seeing excellent opportunities for strong ROE compressor rental additions, and they put those on. They were really ramping their capex very, very hard to grow their fleet. Interestingly, it was at a time when CSI Compresco and a lot of the other competitors had levered up historically. And because there was a big MLP craze from years back where you put a bunch of leverage on these things and you offer a big dividend and put it in an MLP structure. So a lot of compressor rental guys were in these kind of structures.
Hey guys, it's Clay Fink here, host of We Study Billionaires. If you're like me and enjoy listening to podcasts, then you'd probably enjoy listening to audiobooks as well. Whether it's when I'm doing the dishes, going on a walk, or driving to the gym, audiobooks are such a great way to continue on this journey of lifelong learning. And if you haven't signed up for Audible yet and you'd like to support We Study Billionaires, I'd encourage you to use our affiliate link and start accelerating your learning journey today. Also, if you haven't read my co-host William Green's wonderful book, Richer, Wiser, Happier, I'd encourage you to start with that one. Immediately after you sign up for your Audible subscription, you can start listening to William's book for free. Some of my other favorite investing books include 100 Baggers by Chris Mayer, The Joys of Compounding by Gautam Bade, and Same as Ever by Morgan Housel, all of which have been previous guests on the podcast. To sign up for Audible and to support We Study Billionaires, you can head to theinvestorspodcast.com/audible. That is theinvestorspodcast.com/audible. We appreciate you supporting We Study Billionaires.
When interest rates went up really, really strongly, they were in a debt reduction mode and weren't available to grow their own capex. So it left the supply response that you would normally see in the compressor space wasn't occurring because of the leverage of the competitors. And so we kind of saw that dynamic and saw that was a very productive one and bought in. Now, with respect to energy, it's been one of our favorite sectors over the last couple of years. The supply and demand dynamics from an aggregate level appear to me to be really, really unusually strong. You look at over the last probably 10 or 12 years, the U.S. U.S. shale has been responsible for adding something like 8 million barrels a day of additional supply into the system, into the global oil supply. And today, those shale, those levels of shale expansion just do not appear to be sustainable in any situation. It looks to me like it is likely to be extraordinarily flat going forward on an aggregate basis. So this immense pulsing out of additional supply that had come out of the shale plays is likely to end. And on the demand side, there's a little bit of there's a view that in the market that and I think it's driven more by politics than by evaluation of facts, and as a result, there's a view that fossil fuels are going to go away soon. That had been very, very prevalent in the market and still remains somewhat prevalent. I'm a believer in some of the work that's been done by guys like Arjun Murthy at Veritan. Explains that the S curve of development of countries like China and India, you're likely to get, and even Africa, where the per capita consumption of energy is a small fraction of what it is in the United States. And if those just, if you take China and if you take India and Africa and non-China Asia and you bring the consumption levels just up to China, you've got almost a 60-70% increase in the overall demand for oil. So in some ways, if you're going to try to mandate the end of fossil fuel use, you're really mandating that these countries are remain mired in sort of energy poverty in our view. So, but nevertheless, you've got this huge demand, long-term demand trend at your back, and you've got this supply that's kind of falling off. The supply growth from the United States that is just slowing immensely, and I think that's going to create a real inflection, I think, in the market over the next couple of years. And so I like the underlying demand dynamics, and then on top of it, within the energy space, there was an awful lot of companies that were being disposed of from pools of money that had chosen to manage the money based on metrics other than maximizing risk-adjusted return. So, for ESG purposes or other or anything else, but we've been very, in some ways, very happy to come in and take advantage of these kind of pricing dislocations that have been occurring within these companies. So we like energy an awful lot.
So obviously, during this chat, we've talked a lot about book value. You obviously like cheap book value, and we talked a little bit about cash flow generation. So I'm just trying to wrap my head a little bit more around your strategy here. So are you looking at more, the low price to book value being your margin of safety, and then any type of future cash flow generation as the growth driver for your businesses, or just give me a little bit more information on how you use that as a framework for your investing?
Yeah, when we buy these companies, a lot of times if you can assure yourselves that you're buying at a pretty nice discount to book, and the book is real, so we look a lot at book to market adjustments to try to evaluate how good is book value. Sometimes you'll have markets that, book value adjustments that are positive, like, you have a land position where the land is on the books at some, value from 50, 100 years ago. And, then you've got a kind of a hidden asset there, or you can have book value that's overvalued. You have a malinvestment that's occurred that, you've placed your capital in the wrong business, in the wrong industry, in a sunset. And there's a lot of additional reorienting your business structure. Would require a lot of charges and one-time charges associated with rationalizing the personnel or whatnot. And so there's ways that when you look at both the assets and liabilities to come up with your book, there's a lot of work that gets done there. And if you can buy it at a discount, particularly an unlevered discount to those names, clearly that provides us we believe a lot more downside protection, because those assets will be there for quite some time, and can ride through a cyclical downturn in the economy or something. On the, on the flip side, though, sometimes when you're buying it at these levels, when you're catching a bottom of a cycle, the return on equity, the return on that book value is very, very low, and sometimes negative. And so, some of the analysis that we really do is to say, look, we're trying to get through, through a lot of the, how do we get the car through the tunnel without us having to hand the keys to the car over to the banks, and that's really the, there's a lot of analysis that we do at cycle bottoms around that kind of analysis when we do buy companies that have leverage. We want to make sure the shareholders, the equity guys, are going to be able to avail themselves to the recovery before a failure. And so, but presuming that can be done, we're looking several years out, and we're looking for tangible issues that can create an improvement in the return on equity of the business. And there's a lot of and we do this from an engineering type way. There's two ways you can get better EBITDA, right? One is you grow revenues, the other is you cut costs. And what I really want to focus on when we're looking at this, I like the cost side in some ways better, because you can determine how many people, how many heads you've cut, and where what that cost structure that you take out, what that could be, and how that can drive those can drive costs down. I think those are more measurable with a higher degree of confidence than sometimes revenue growth that sometimes looks like a hockey stick, and and sometimes that can get fairly esoteric, and I prefer to try to tie that back to tangible situations, like we were talking about CSI Compresco, where we have there's been $60 million that have been spent on compressors, and they're going to come on in the next 15 months, and here's what they could earn potentially at a 20%. If they were put on at 15 to 18%, ROEs, and it's that kind of analysis that we like to see. So, newly contracted situations, or areas where we've already seen the price movement because two competitors have merged, and the pricing in a business has gotten better, and so you can then say, well, as all the contracted, as our supply boats all come off of contract and they get renewed, here's the bump up in revenues that we're going to see. But we have as a tether, we could tether that all to today's day rate, and say, hey, the day rates have already moved. And I find that to be so much a much more a much more tangible thing to bet on than kind of the cell phone penetration is going to be X plus 10% for the next 10 years or something like that, where these to me are hard harder to determine.
So one of the more prominent trends today in investing is investing in high quality businesses that can be held for decades. Warren Buffett has obviously had a big effect on investors looking for these. Now, your strategy isn't really interested in looking for the highest quality businesses, because oftentimes those businesses aren't trading for low price to book. So I'm just interested in learning a little bit more about how you view quality. How are you looking at quality in terms of your own investing philosophy based around that low price to book?
Yeah, that's a good question, because I think there's a lot of misunderstanding around what value investing is all about. Where we all love quality businesses. It's I guess the real question is, can quality, what is the price of quality? And at the moment, my perception is that that it's really important to have that quality is trading at a really very big premium now to cyclical stocks that have more volatility of their earnings. So and I think my guess is that, again, that a lot of that has been driven by the ability for quality companies to in a time when debt is available and very inexpensive, to lever up and lever up a more stable earnings stream. And so, if the problem of the economy has been too much debt, then I think maybe quality companies getting a premium might be somewhat related to that. And so I prefer to stick with some of these other companies that might be perceived as low quality or lower quality, but even that, I would say with more volatile earning streams that get perceived as lower quality. Because I think in many cases these companies have been have reduced financial leverage pretty significantly over the last several years, because they've been in some cases, because of ESG, in the fossil fuel business, they've been kind of starved of their bank lines, and as a result they've really pulled down on their leverage. Quality businesses, the ones with stable earnings and stable, slightly growing earnings are ones that are kind of the darlings of the private equity buyout craze. And I find it interesting that Dan Rasmussen and Verdad, he's done a lot of work on the valuation that a lot of these businesses have been bought out at. These quality businesses have been bought out at, continues to climb higher and higher and higher. And so there's an awful lot of kind of high multiple companies inside the private equity space, and I think there's high multiple quality companies inside of private equity that if there is a downturn and an increase in interest rates, which has already occurred, if a lot of these guys, as they start to roll roll their corporate debt up to higher today's market rates, there's likely to be a lot of damage in that. And we're going to see perhaps a decline in the valuation of quality companies. And at that point, I think we may make a shift and get back involved in more stable earnings type companies. But for the time being, I think there's a lot of kind of systemic financial risk that's kind of associated with low vol and kind of quality type companies. So we're kind of holding off on that. Yep.
So continuing on with the topic of quality here. So I'm going to loop it in, but I love asking really good value investors just about how they monitor their investments and also how they approach the selling process. So obviously with, your style of investing, you're most likely you're buying these businesses lower than intrinsic value, than selling when they get close to intrinsic value. But I'm also interested in learning a little bit more about, what about businesses maybe that have, maybe they increase in quality while you own them. Maybe it's a hidden increase, or maybe it's something that you did account for. Are you willing to hold these types of businesses past intrinsic value if they're increasing their intrinsic value at a high enough rate? Just give me some more information on that.
Yeah, there's clearly a lot of tax advantage to writing a business that continues to grow, and it allows you to take advantage of growth in your own capital and growth on your capital and compounding without having to pay taxes on that capital. And as opposed to the sort of cigar butt approach, clearly where you're buying things, then you shift out into something new, and you're clearly, that's a very high tax arena. I think sometimes the valuations of the companies have kind of adjusted to account for that. So you get perhaps better valuations within within our space because of that tax issue that occurs. In terms of kind of the sell discipline or selling decision, I think one of the biggest issues of sell discipline, one of the biggest reasons why investors, or professional investors anyway, might not be have problems with sell discipline, I think, is that they have a fully invested mandate, and so they are then forced to hold things longer than they like they would otherwise. And so I find some of that. So we don't hold ourselves to a fully invested mandate. We'll have higher cash levels from time to time, with cash being a derivative of the investment process. And when the stocks end up, I guess there are a couple of reasons why we might sell something. First is kind of the positive thing. The stock goes up to the point where the multiple goes higher, and becomes more of a market-based multiple or above market-based multiple, where it's above our assessment of intrinsic value, or at that assessment, where the margin of safety drops off because of a share price appreciation. So we'll sell under those scenarios, and if we don't have something new to buy, we'll just hold cash. And sometimes in another case, something will be still at a discount, but all of a sudden we'll find something new in the portfolio. We'll be 100% invested, and we'll find something new outside the portfolio that is a really good investment, and it'll be worthwhile to swap, despite the fact that we're selling an investment that we still believe is somewhat undervalued. So we'll sometimes pull off the swap when we can get a bigger margin of safety elsewhere, a risk return profile elsewhere. So and then I guess the third, which is that the problem case, is where clearly you've some new piece of information comes to light that makes you question your original analysis, that you thought you were buying a dollar for 50 cents, and you turned out you were buying a quarter for 50 cents or a dime for 50 cents. And then under those sort of scenarios, those are really the most emotionally frustrating. But I think it's important to really be willing to assess that accurately and not be kind of stuck in your your kind of behavioral biases and exit. You don't have to. I keep trying to remind myself, you don't have to make your money back where you lost it. So.
Yeah, I like that Buffett quote. So as of June 2023, Aegis's employees and their families invested a combined $48 million in the fund out of total assets of $342 million. So I'm just interested if you could comment a little bit on how you've created alignment between investors and employees in the fund to maximize value for both investors and your colleagues and yourself.
Yeah, I personally have an immense amount of my own personal wealth. I think the vast majority of my personal wealth, liquid anyway, in the fund. It's the way I personally would choose to place my investments. So I think I'm fairly strongly aligned, and eat the cooking even when it's pretty cold sometimes. I think with the other employees here, we don't have a real requirement that they. I'm kind of a freedom guy, a liberty guy. So I let people kind of decide how they want to do it. That said, what's been interesting is that over time, a lot of the people who do work here end up owning a pretty nice piece of the fund as well.
Excellent. So during my research process for this call, I found another quote that you had that was really good regarding reputation. So you said, as a deep value investor, if you get it wrong, you can get hit. It's one thing to forecast Cisco earnings wrong in 1999 and lose money conventionally. But if a deep value manager loses money failing to spot an accounting scam on, say, a small mining stock, that can really damage their reputation. Now, this makes me think of one of my favorite John Maynard Keynes quotes, which is, worldly wisdom teaches us that it's better for reputation to fail conventionally than to succeed unconventionally. So, you've managed to avoid probably a lot, hopefully, of unconventional errors over the years. Now, I'm just interested in learning a little bit more about how you've managed to do that.
Well, I wrote that quote. I think I kind of wrote that kind of trying to explain why precious metals mining is such an interesting area, because I think there's probably few businesses in the market where it might being wrong would tend to create a lot of the crowd would very quickly determine that you're kind of inept, and so these shares carry a high degree of reputational risk associated with them. from an investment manager perspective. And as a result, I think they trade more cheaply than the broader markets. And so I really, it's been an area that, where there's been a lot of misperception with respect to precious metals, where the average the average guy thinks what a mine is. A mine is a hole with a lyre on top, or so. And when you really dig in, you begin to realize that particularly after the 2013 to 2015, when the GDXJ, the mining index, dropped something like 85% in the context of a rising market, it just blew up all the mining investors out there. They just lost just about all their capital. And what was left in the business was the folks that were the liars on top of the mine, the liars on top of the hole in the ground. They'd moved on to greener pastures. They usually don't take a down 85% a market to work in. They went on to Bitcoin or whatever else, that's more greener pastures for the speculators. But what they left in the mining space was a bunch of really interesting engineers and technical people that I thought were really, as an engineer, I found I found a lot of I appreciated and enjoyed, and I felt like they were very focused on on albeit a volatile business where the commodity changes, and that can create a lot of differences. But I thought it was an interesting area to be able to dive in. And precious metals is so interesting too, is that a lot of these guys have third party reports on the reserves, and so and on the mining plan, and on the and all of that. It gets these engineering reports are available for everybody to read. And so the level of publicly available granularity is significantly higher in the mining space, which is something that is totally off from what my original perception of mining might be. So being able to get in and do significant due diligence on these things, and be able to tether your due diligence to third party mining reports and whatnot, it can be a very helpful way of avoiding kind of getting hurt in a situation. It's kind of interesting. I think there haven't been that many times where I can say somebody has really lied to me over but what I find kind of intriguing is there are generally two kinds of ways that people will obfuscate. And the first one I find I can identify very, very easily, and that's the guy who just doesn't want to get into the detail. Because normally, if you really love what you do and you find the right guy, they just really want to talk to you about their business and are excited about it, and are willing to give you. It's like sometimes it's like drinking from a fire hydrant or something. So they'll give you But there's a second level of person that I have a much harder time with, and it's the person that will give you it's the realtor or something that will give you the great deal of detail on the granite in the kitchen, and it makes you think, well, they're an honest broker because of the level of granularity that they're giving you and detail they're giving you. And meanwhile, they're totally ignoring that the bathroom is smoking or something. There's a fire in the other part of the house or something, and that's a tougher one, because you end up getting somewhat you feel a little more affinity for a person who gives you that level of detail, and you give them the benefit of the doubt that they're really giving you everything they think. So that's something I'm still working on.
So I'd love to learn more about the drawdown that Aegis Fund went through in 2007, 2009. So this was probably a pretty painful time for you, as the fund went down about 72% during that period. So I'd just love to know more, how did you navigate this investing experience? And, did you ever feel at that point that your strategy was no longer viable?
Wow, that was a tough time. I just had my first child in '07, and so my wife and I were watching Friday Night Lights, and I'd been born in Texas and gone to school there, and so I really liked the Friday Night Football series. But they had the slow guitar music and in the front of the show, and I felt like I'd gotten up and crashed my car every day coming home for weeks, and then watching one or two episodes a night and going to bed. For years after that experience, when I heard that kind of show and the guitar music, I kind of get chills because it's a very, very tough time. Probably the toughest thing I've really ever gone through. Interestingly, with the kids wanted to watch it in 2020 during COVID, so that was a recast there. But in terms of the drop off, these companies were trading at valuation levels. When you sat down and you looked at the valuations, they were absurdly cheap. It was not a problem. On the whole, in our stocks, it was much more of a problem of the other shareholders of the companies and not the companies themselves. Coming into 2007, a lot of the quantitative guys had really ramped up leverage on and playing of the value factor. So they were buying a lot of discount to book securities, and and they were shorting out high price to book and playing convergence. And that those guys were had gotten blown up in latter part of '07 even, and then it's all sort of cascaded to the point where the proprietary trading desks of a lot of the brokerage firms that held a lot of the deep value special situation stuffs we were dealing in were really getting repo funding pulled, and were being forced to liquidate by these companies. And in the fog of war, you kind of knew part of the story, but you didn't know the whole situation until months and years later, really. But you're trying to assess everything that is going on. But when in the case of our fund, a lot of companies were trading down to very, very cheap multiples, even discounting a recession or a deep recession. And some of the companies, the leveraged companies had some more significant declines, but some of them, had no debt, and sometimes companies were trading it, down to levels below the cash per share. And so, it's not like, so I didn't feel like, oh gosh, unless the government bails out everything, we're going to, these companies are going to go to zero. It seemed pretty obvious that there was going to be a purge of whatever these margin calls were all going to cause. And then there was going to be a reset. And interestingly, in '09, we went down. It was another 25-30% to the bottom in '09, just in year to date '09 alone. And then we ended up for the year at 91%. And and then of course 91% got us on the cover of the Wall Street Journal or whatnot, and and saying, how did you do this? How did you navigate through it? Well, I felt very sheepish about that because I didn't do anything. I just held the same thing, and the stock price went down because they were purging out shares, and then the stock price came back because they finished. And I think our holdings would have lasted a lot better even if the government hadn't done the big bailout. So we weren't like a lot of the investment banks that were really going to be zeros if the government had just let the free market take its toll. These companies that we had would have struggled, but they would have maybe in a poorer market. But I think they would have come through with significant value on the backside of some of this. Now it certainly may have taken longer if the Fed hadn't, kind of went and juiced the monetary system a bunch. Um, but yeah, so that's kind of I guess here the point I was thinking. The other thing was that the source of stress for me during that time was one of more, I'd built up a lot of clients, and it's not so much a worry that the stocks are not going to recover. I had pretty high confidence that they would be able to recover, and just a matter of just kind of waiting for the time for them to do it. The real stress was the clients and the fact that they, as they panic and they pull assets, there's no opportunity to recover out of those assets and come back. And so your permanent business value begins to suffer. And then you worry about everything in all the employees in the company here, and how are you going to pull through? So that was a source of stress, but the underlying companies, not so much. I think, of course, but not, that wasn't the key source.
So in your manager's letter from 2023, you mentioned how scary that the S&P 500 currently looks due to the multiple expansion of the Magnificent Seven. And it's, gotten worse now. So it appeared at that time that a lot of the future growth was already priced into these stocks, and, any potential earnings misses could clearly have significant impacts on their high price earnings ratios. So, I don't need any predictions from you from going from here, but, what are your thoughts on the S&P 500 today, especially, in regard to the valuations of the Magnificent Seven?
Yeah, I was pretty shocked, to be honest, around the significant recovery of the tech stocks that occurred in 2023. I thought that this kind of I thought there was sort of a bubble earlier, and then in 2022, when the valuations came down significantly on these, I thought this was the start of a longer term, a longer term trend, and was a little bit surprised that we had the AI driven sort of reversal that once again reignited so much of the animal spirits here, particularly in the context of a interest rate that had already had been hiked up real high. Historically, when when the S&P was very high, people would say, well, that's because the interest rates are very low. So on an interest rate adjusted basis, it's not really all that, the multiple's not all that stretched. But now you have interest rates at a fairly high multiple, a fairly high level of yield, and yet you have these stocks having ripped higher, a very focused subset of these stocks really driving, very narrow market driving everything. One of the highest percentages of stocks in the S&P 500 are now have been underperforming the S&P because they're not the seven. I guess I look a lot at thought about the work of Michael Green and Einhorn, who've talked about the market sort of being broken, and Horizon Kinetics has done some great work on, the impacts of this immense fund flow that's been going into passive. I think there's kind of this belief that, oh, well, we can just set it and forget it. You just put this money in this fund, and you have there's no need to do anything else for the rest of your life, and you're going to be fine. You're going to outperform most money managers, or something like this is the way it strikes me. What other investment product? And I think Horizon Kinetics had mentioned this, so I want to give the credit to them, because it was something I really, resonated with me. what other investment product do you know of where you can set it and forget it, and that works in the long run? There's, I think there, Michael Green has done some work on this that shows that, maybe there's some market cornering aspects that are going on within the S&P, and maybe the top stocks of the S&P, where they're becoming higher and higher valued. I find, clearly there's been within NVIDIA, which sits at the top, there's been strong earnings growth, but the sustainability of that, I would put in some question. I look at just the energy consumption of the NVIDIA chips that are supposed to be put out just this year. Each chip requires as much energy as one household. And when you look at the 2.5 million that they're contemplating putting out, that's like a city almost the size of Houston that you're going to put into a 70-year-old electricity grid, and that doesn't want to work on, doesn't want to use coal plants, hasn't built a nat gas plant in years, and doesn't like nuclear either, and just wants to run on solar and wind. I find that there's going to be it seems to me the emergence of a lot more I guess bottlenecks to the ability of these companies to continue to to grow, for sure, but also even to continue to produce at today's levels with the margins. And as such, I think we may be at a time that could be close to 1999 again, where you had the NASDAQ 100 that lost something like 75% of its value after the once we got through March of 2000, and so I think there's some real risk in that sector of the market. I think for those who have been fortunate enough to have played in that, I think it would pay to remember what Sir John Templeton said, that it always pays to change a winning game. And I think there's I can say it, but the chances of number of people doing it are very low. But for a guy to have done this and to have the mental acuity and agility to get off of these and to get into some of these others that haven't performed as well, because the market is hugely binary. And just like in 1999, when the tech stocks had sucked money out of everything else, clearly when you look at fund flows, information technology fund flows are way high, and a lot of energy and so forth that continue to lose some assets. And so there's a real opportunity here for somebody that has that mental agility to switch into things that are much, much cheaper, and perhaps get a double run, and clearly miss the backside of this. That could be pretty nasty, I would think. So yeah, that's kind of what I'm thinking about the market. There's a real big opportunity for somebody who's made money in it to kind of pull back and reassess. I think I would suspect that the future returns of these kinds of companies are going to be significantly more muted.
Scott, I just want to say thank you so much for coming onto the show today and sharing your excellent insights. I'm just going to hand it off to you. Where can the audience, learn more about you and the Aegis Fund?
Well, thank you. I really enjoyed doing it. I've loved this podcast for so long, and it's been a real delight to be on. Yeah, you can find me at Aegis Funds, AEGISFUNDS plural.com.
The key learnings that we made inside the investment committee over time: having the discipline to hold your winners. And winners, it's not necessarily stocks that went up. Eventually that converged, but winners for us is business that can compound because they know how to reinvest. And as they reinvest their earned capital, the moat is increasing.